All right. Well, thank you for joining our webinar on alternative investment portfolio construction, key consideration for public pensions. My name is Hank Kim, and I'm NCPERS Executive Director and moderator for today's session. As many of you know, constructing a robust and resilient alternative portfolio is no small feat. There is constant balancing act between strategic asset allocation and timely, dynamic decisions. And with illiquidity often the defining uh, trait of alternatives, the stakes are high, but well-informed moves can meaningfully improve long-term outcomes. Today's discussion will focus on the big questions pension plans are asking now, such as the role of alternatives in pension portfolios, balancing investments in private and public alternatives, and how to size long-term positions in alternatives, among a number of other questions that we'll address today. To help us explore these questions, we're joined by two distinguished experts. Pulkit Sharma is the head of Alternative Investment Strategy and Solutions at JP Morgan Asset Management, where he leads the development and execution of forward-looking alternative asset allocation frameworks and proprietary multi-alts market views. Our second panelist is Susie Ardeshir, who is the Executive Director and CIO of the Arlington County Employees Retirement System. She brings real-world implementation experience from the public plan perspective. I'll be guiding the conversation and we'll leave time at the end for your questions. So please feel free to submit them using the Q&A function at any time during the session. All right, let's get started. Pulkit, let me start with you. The demand for alternatives have grown tremendously over the years. Why have alternatives become essential and not optional in portfolios?
Thank you, Hank. Well, I think there are three main reasons. The first one is today we are in a regime where a lot of the macroeconomic variables have moved a lot. So there is a higher rates and higher inflation from a forward-looking perspective, and that causes stock bond correlations to rise as well alongside them. So there is a need for diversifiers, adding diversifiers to portfolios. That's one reason. The other is for plan sponsors is also the ability to add returns over and above their public market equivalents. So the alpha generation aspects of alternatives is the second. And the third is we are in the policy backdrop or the geopolitical backdrop, there is spikes in inflation. And so real returns matter, and the ability to generate inflation resilience is another attribute which alternatives do provide. And so as an example, real estate is a classic diversifier. It has local economic drivers of returns. Private equity, as an example, is a return enhancer. That return enhancement comes from operational improvements, leverage sector selection, and multitude of factors. And then there is the need for inflation resilience. So asset classes like infrastructure have explicit or implicit inflation sensitive characteristics and a productive use of capex in an inflationary environment by their increase of ROEs, for example, in the utility space of infrastructure. So there are many such examples. The point is that what you can solve from in alternatives is what we coined this phrase AID, so aid. Alternatives can deliver aid to traditional portfolios. So you can solve for A and I, D and I, or all of the A and I and D together when thinking about using alternatives. And these are the reasons why we see them becoming more and more essential in investor portfolios today.
Great, thank you. Thanks for starting us off strongly. Susie, let me ask you, do you have anything else you want to add or any additional color to Pulkit's description? And secondly, like which of the outcomes do pension plans focus most on with respect to alternatives?
Okay, thanks. Maybe I'll add on to that, but with regards to the aid, I think, as asset owners, the first step is really the asset allocation process and the strategic asset allocation. And that really relies upon the return assumption, which in this case is referenced as alpha above public markets and as capital market assumptions as many of us have seen over the past decade, and as alternative investments have grown within portfolios, they offer a premium over public markets. And when you input into traditional models, also they offer a diversification benefit because, as we'll look at later and discuss, correlations as well as risks tend to be in line with that of public markets, if not, and then lower correlated to the publics. So what that intuitively does is it results in the models pushing towards alternatives, right? If the model could 100% invest in alternatives, it potentially may. But then in practicality and reality and implementation and portfolio construction, we're limited to, constraints. How much are we able to take on illiquidity risk? Costs, operations, and the role of the strategy. So typically inflation may not be a core considered component of asset allocation, but when you're constructing the portfolio in alternatives, you may be looking for different types of outcomes from different types of assets, and that's where the other factors or considerations come into play. So I think primarily where asset owners are first focused from an asset allocation perspective of return and diversification, and then implementation becomes an outcome. And but there has been, and we'll talk probably later, probably a shift towards thinking about that more holistically on outcome orientation allocation. But I'll stop there. So
Great. Thank you, Susie. Pulkit, going back to you, let's talk about some of the investment principles your team has developed and practiced from working with global investors over the decades. Is there a benefit in combining public alternatives with private alternatives in portfolios? And how should plan sponsors think about this?
We believe, yes, there is a benefit. And I'm going to highlight an example to make the point, which is this is an example of real estate as an asset class. And we show the combination of public and private real estates on there are three reasons why actually that is important. The first is you get better risk-adjusted returns by that combination. It has to be a thoughtful combination. Secondly, a broader swath of sector exposures, and also flexibility. The risk-adjusted returns is highlighted by this chart and this research, where the first column on the left-hand side is private real estate. On the last column, on the first column, the left side is private real estate. On the right-hand side, the last column is REITs, so publicly traded real estate. So as you can see that there's a combination of 100%, so left is 100% private, right is 100% public. At 20 to 30% level of adding public REITs to private real estate, you see that the risk-adjusted returns actually improves. But the outcomes are definitely very different across public and private. So private real estate has similar returns as REITs, but it comes with lower volatility, lower tail risk or downside risk, and lower beta or linkage to equity markets, which is much higher in the REIT space. But at that 20 to 30% level, you can start improving risk-adjusted returns. So the volatility and the downside risk do not sort of get enhanced at that proportionate level. The second point is when you do that, the last row on this chart shows the extended sectors. So there's a big sector difference between public and private real estate, whereas mostly the private real estate market is traditional sectors, the big four sectors: office, industrial, retail, multifamily. Whereas, as you can see, 55% of the REIT segment is extended sectors. So at that smaller allocation, you get exposure to these higher growth extended sectors, which is one of the reasons why REITs tend to be similar or higher performing than core real estate. And the third reason is that while private real estate in general has lower liquidity than REITs, which are daily liquid, the combination can opportunistically have more liquidity. Although in this combination, both are investment tools, there is opportunistically you can enhance the liquidity profile. So for those three reasons, this page illustrates the combination is stronger, but you have to control for that public allocation. And the similar inferences can actually be drawn for public to private infrastructure, public to private equity, public to private credit, with different nuances of their sector blends as well as their risk profiles. But we believe that stronger portfolios can be generated by looking holistically across the full spectrum. And ultimately, a building does not know who its owner is. So it could be a private real estate fund or a REIT. And these are all structures. So a broader, more holistic approach can be utilized using this kind of a construct.
Great. Susie, what are your views on REITs? Should it be put in the real estate bucket?
If there is a real estate bucket, I do believe then yes, it should be put in the real estate bucket in the allocation. I will just draw some historical reference. REITs and real estate almost a decade ago became part of the public benchmark indices. And that's where I think you also saw a shift from REITs being part of the real estate allocation to becoming part of public equity if you do hold REITs. Historically, as people were building their real estate allocations, either to open-end or closed-end funds, they would use REITs as a funding source within their real estate allocations and then allocate from REITs to either the closed-end separate account structures. So I think it's also how REITs are classified is how you define them within your alternatives or your asset allocation structure. But I think given the acceptance and adoption within the public equity index benchmarks, it made them an equity comparable option, or people thinking about them in the views as equity-like, although they still observe both equity and income-like characteristics. So it depends on the mindset of the allocation of how and where it should be classified.
Great, thank you. And just as a reminder, again, for the audience, if you have any questions, please type them into the by using the Q&A function of the Zoom platform. Also, if you'd like to see the PowerPoint presentation, I believe we'll be sending that out to the attendees after the webinar. So with that, Pulkit, let me ask, with the increased adoption of alternatives in portfolios, one of the challenges has been performance comparisons across open-end evergreen strategies reporting in time-weighted return versus closed-end strategies reporting in internal rate of return. Are these return comparables, or are these returns comparable? And if not, which metric should plan sponsors use for comparison?
Yeah, I think this topic of return measurement is often quite misunderstood in the alternative space. There's typically varying measurements used to measure outcomes. As you said, the evergreen strategies or open-end strategies, or let's call them core, typically measure their performance in time-weighted return terms, which is how stocks and bonds measure their performance, whereas the closed-end drawdown structures typically measure their performance in internal rate of return, or IRRs. But IRRs and time-weighted returns are apples and oranges. And this page shows that. We show three scenarios. The first one is a drawdown structure, which is drawing capital. You see the J curve of capital calls, and there's distributions. Distributions are front-loaded. So you can see that it has a meaningfully high IRR of 19%, but the multiple on invested capital, so MOIC, multiple on invested capital, which is how much do you put in and how much do you get out at the end of 10 years, is two times multiple. The second scenario highlights a closed-end drawdown structure where the distributions are back-ended rather than front-ended, and you can see the IRR is 11, but also a 2x multiple. And the third format is open-end funds, and they are typically one capital call, and they compound capital. And there the multiple is still 2x, but the time-weighted rate of return is 7%. So each of these scenarios delivers the same end return, because the return that should matter to any investor is how much did you put in and how much did you get out. And that is measured by the multiple on invested capital, MOIC. So the IRRs and TWRs are totally different nomenclatures and not cross-comparable. And we believe that like a net of fee multiple actually is cross-comparable across the alternative asset classes, which is oftentimes sort of, they are seen as the same metrics, but they are not, is what this research shows.
And so, Susie, how are you and Arlington comparing performances across open-end and closed-end investments?
Okay, well, performance comparisons, I will echo what much of Pulkit has said probably, but across investment structures can be very misleading and highly dependent on the time horizon used. Typically, as asset owners, we review performance on a quarterly basis, but then our long-term capital. So we're focused on the long term, be that 5, 7, 10 years plus, right? So thinking within that construct, but to make it comparable, you also want to revert back to the underwriting thesis of what you expect out of the underlying investment, and then compare it to expectation and realized outcomes. And, If you've made an investment in a newer fund, the 1, 2, 3 year performance on a time weighted or even it's not relevant. But as Pulkit mentioned, looking at it on a multiple of invested capital actually makes it comparable, because it also makes it easy to translate, right? If I made $100 investment and I got $100 back, well, I've made it 2x, right? So you want to understand that in the dollars that are also coming back, because those are the dollars you need to reinvest in the future to compound further returns. So there's not one view, there's multiple lenses and views, but I do think it is very hard, depending on time horizon and metric, to what to use. But if you think about, dollars returned back or the multiple on invested capital, it makes it kind of uniform across, be it a public or a private structure. And always remember your underwriting, why you chose to invest in that, because there can be cycles and different times in the market.
Yeah, great advice. Thank you, Susie. Pulkit, going back to you, core versus non-core investing in alternatives. First, can you define these for us? And how should plan sponsors think about investing across the spectrum?
Yeah, I think there's multiple definitions which are used in industry. We use a definition for core, I'm happy to share some research on this topic as well. But the core, this page, but the way we think of core is very simply any asset classes within alternatives which have predictable cash flows as underpinning their returns. And the predictability of cash flows, so higher quality asset pool is what we will define as core. And then the opposite of that would be non-core, or simply put, like capital appreciation basically is the dominating factor from a return component perspective. So that's the delineation. So income or cash flows dominate returns will be core. And then when you look at the performance comparison, back to the previous point on looking at MOICs or net of fee multiples for comparing performance, we did this research here, which lays out the performance of core versus non-core on an apples to apples basis for different years. So every bar here represents if you invested in core, average core strategy, and on the orange bar, the yellow bar represents non-core strategy at the full basket or asset class level, and you held it for 10 years. So what would be your net of fee multiple? And when we look at these data, it shows something very counterintuitive. It shows that actually core strategies, the average core strategies outperform top quartile non-core strategies 50% of the time. And the average core strategies actually outperform the average non-core strategy 90% of the time. And so the question is like, why does that happen? Because those are higher returning strategies. And so the rationale could be explained by the fact that there's more operating risk at the non-core level. There's also a lot of leverage risk. So it's risk on risk. And typically the fee levels are higher as well. So all of that the binary outcomes and more dilution leads to these types of outcomes, which doesn't mean that non-core doesn't have a role. Like the insight we have here is a couple of insights which come out of this. The first one is it's probably more prudent to build a foundation in core strategies of when you're sort of accessing alternatives, and then use the satellite approach for the non-core strategies, and then go for higher conviction and thematic approaches there. And it's hard to do that, but that sort of approach can sort of lead to better outcomes. And the second is it's the idea of looking at maybe like the core side has sort of, I would call it, low risk assets underpinning those strategies. So maybe applying more leverage on the core side can get to similar sort of opportunistic outcomes at more efficient pricing levels than sort of taking on levering up something which is already higher risk, which is how sort of this is what the data shows, and there are a couple of implications that we wanted to share with the data, but I'll sort of stop there.
Great, thank you, Pulkit. Before we shift to the next set of topics, I do want to let the audience know, if you are following along in the chat, you'll see that there is a link so that you can see the presentation that Pulkit is using, so you can follow along in real time. And again, any questions that you have, please use the Q&A function. We already have one question in there that will ask at the end of the presentation. So, as I alluded to, we're shifting gears from investment principles to portfolio construction. How should plans think about sizing their alternative allocation? Pulkit, we'll start with you again.
I think anything sizing, first we have to solve for what are the building blocks for sizing. So I think this page shows that for any asset allocation exercise, there are three building blocks, which is what's your forward-looking return, what's your forward-looking risk, and what's your forward-looking correlations. And then you can go from there to size positions across the full spectrum of alternatives and in the broader portfolios. So what I wanted to highlight here, you can see all the numbers, is that it's very important to do this on an apples to apples basis and look at these return outcomes. So we talked about this earlier, which is returns should be cross-compared in a time-weighted return basis. They're all apples to apples then, not IRRs and time-weighted returns for anything asset allocation related. They should be looked at the asset class level and net of fees. So then you have a framework where everything is appropriately positioned from a return outcome perspective. And similarly, on the risk side, it's no new news that alternatives have smooth valuations. So adjusting adjusting their volatility to, or like maybe penalizing it to make sure that their risk is appropriately measured is also a prudent approach. So otherwise, what ends up is a garbage in, garbage out situation where you end up not positioning them appropriately in the broader portfolio. So that is the key point I want to highlight, that the building blocks themselves are very important for anything sizing. And then when it comes to sizing portfolios, we had 10 years ago, we were working with a sort of plan sponsor to build out their real assets portfolio. Their real assets portfolio, and imagine 10 years ago, the menu of real assets was narrow and also data was a lot less available at that point in time. So they compared the approach they were taking to finger painting in terms of building a real assets portfolio at that point in time, which was, I think makes sense at that point in time. But today, fast forward, there's a lot more data which is available across, and the menu is also becoming larger, not only in real assets, but it's a broader alternatives space. So there are many, many approaches which plan sponsors can use to size and right size their alternative portfolios. One of the most commonly used approaches, modern portfolio theory, or the mean variance framework. It has its pros and it also has its disadvantages. It's commonly used. The challenges are it doesn't accommodate for the tail risk characteristics which alternatives have. And also it's very sensitive and gives very concentrated portfolios when you don't constrain it. But when you constrain it, then you're trying to get to the answer you already want. So the point being, there are more approaches which are available, which consider downside risk, which sort of can right size based on the risk contribution, which can right size based on beating absolute return thresholds. The suggestion here is that whatever approach you use, you should sort of align it to the objective you're solving, and then be aware that there is more data available and the menu is much larger. So going beyond finger painting and you'll be using more science and less art may be a good way to approach alternative portfolio construction in the future.
Great, thank you. So Susie, given sort of the table that Pulkit has laid, how do public pensions size their alternative portfolio allocation?
So I think once an asset allocation has been determined to, say, let's private equity, and then if you take private equity below that, you may have buyout or venture capital or co-invest and these different kind of sub-asset types within the broader asset classes. Typically, a pacing analysis is done, is how much should be committed in the next given year to kind of meet the target over 3, 5, so forth horizon. But what that is actually, it's quite difficult. And actually developing the right sizing as well as the appropriate allocation, because maybe the opportunity set is changed from where the private equity allocation wants to be in 3 or 5 years, and real assets may look more attractive. So being flexible in that approach, but I think it's a combination of approaches, and there's not one size fits all. I think it's looking at it across multiple lenses, but you want to combine the pacing analysis with the implementation preferences. And then if you can think about that, that's the constraints you put in. How much am I willing to have of my overall risk allocation in a certain asset class or asset type? And then fit and alignment, right? I think it's also critical to look at that alignment with the partner as well as the strategy to the overall alternatives portfolio and the total. Because it's not just accretive to alternatives, you want it to also be accretive or risk reducing to the total. So looking at it from multiple lenses, and I would say also there's not one view, and we all have access to multiple providers as well as tools. So just ask, your big partners out there to look at how they would construct portfolios. They have very specialized teams like, Pulkit and his team that love to do this analysis all day, every day. And so it also provides a different view from maybe, the consultant view as well. So it's nice to be informed of various kind of information points or education to make the best decision. But it's the finger painting is a good reference because it is a lot more art than science, especially in a lot of these modeling techniques. And so taking different looks.
Thank you, Susie. Great suggestions. Pulkit, going back to you, what are the sources of alpha in alternatives, and how can investors tap into this alpha?
Yeah, if I so looking at the data again of the full myriad of alternatives, we can sort of isolate two areas in which returns could be added beyond, let's call it median returns, or they'll call it beta returns, and two sources of alpha. The source number one, which is commonly talked about, is manager selection. And then source number two is asset class selection. And this page helps quantify that. So the left-hand side chart, you can see the dispersion between top and bottom managers. And you can see that's there's a very wide dispersion of outcomes in capital appreciation segments like opportunistic hard assets, real assets, or private equity, even venture. So in those areas, there's very wide manager dispersion. Again, I would sort of caveat that it's not easy to select the best manager all the time, but you can sort of see that you can strive to do that in areas where there's capital appreciation as the dominating factor. On the contrary, look at the last bar in purple. That is core real estate. So the dispersion between top and bottom manager is quite narrow. It's still there, but it's very low relative to what you find in the capital appreciation segments. And on the right-hand side of that chart, we showed a dispersion. So if you take core as a category or higher quality pool of alternatives, it used to be just core real estate 15 years ago, 20 years ago. And now there's a different types of flavors which investors can access, which are income-oriented, but they touch on various alternative segments: infrastructure, transportation, credit, even high-quality publics. The dispersion between those segments is also massive. That's 20% per year is the dispersion, and there's quite a bit of a persistence of that dispersion and the trends. When one asset class starts outperforming, it outperforms for quite a bit of a long time. So acknowledging these two sources of dispersion in portfolio design is important for harnessing those premiums which alternatives can deliver.
So in terms of dispersion, is it possible to actively rebalance and evolve portfolios in alternatives given their illiquid nature?
Yes, so it is possible. And so this page is a process we use to build portfolios. And I'm not going to go through the process, but we talked about sizing positions as a first step, which is what's your long-term guidepost of building a portfolio. But after that, I think the step which is important is what are the practical tools which investors have for rebalancing and portfolio evolution when they look at their alternative portfolios. And oftentimes, what happens is there's a perception, or the the anchoring to a private-to-private rebalancing, which actually is admittedly highly less efficient and hard to execute. But what's executable in terms of thoughtful rebalancing and portfolio evolutions is using new contributions, using portfolio income, using distributions, using public to private and private to public rebalancing. Those are highly executable tools to a greater extent for practical rebalancing and portfolio evolution. And to actually execute on that, what's required is a framework where you can rank order a forward-looking near to medium-term opportunity set on what's high, what's peaking, and what's troughing. So that kind of a framework added to the practical tools can aid, again, stronger portfolio design for plan sponsors.
Great, thank you. So Susie, again, going back to you, it's sort of as a touchstone of what public plans do. So how do you do it at Arlington for rebalancing across alternatives?
Well, I would say Arlington is unique in that we do not have a dedicated specific strategic allocation to private investments. We look at it more from a liquidity management and how much maximum illiquid exposure the overall portfolio is willing to take or able to take. But I would say historically within the space as well as the industry, it's typically more of a rebalancing exercise within strategic asset allocation. So you may, add more to private equity if the capital market assumptions or the expectations are that it's going to deliver higher returns over the next 3, 5, 10-year, whatever the horizon being looked at. Or maybe real assets as, the macro environment has changed and maybe more inflation sensitive, income driven, also where rates are and the broader macro economy. But I think that's primarily the tools that asset owners and plan sponsors have to rebalance within the portfolio, unless they need to be forced sellers. And as forced sellers, what we have seen is there's increased use of the secondary markets. That's also potentially a way to build up later stage exposure to mitigate some J-curve effects or going to the secondary markets. Some have used that as a resource as well. And another source that maybe is more done on the sovereign wealth private side, others is peer-to-peer transactions. I would say is not as common, but as a forum like NCPERS or kind of asset owners kind of maybe not using the secondary, but if they know if people want to, again, I think that's a long way standing, but that may be also another form of an exchange. And I do think there's platforms trying to make that available, that if asset owners did want to rebalance or change their portfolios as another tool to use, but typically within asset allocation versus actually exchanging in the markets.
Great, thank you. Pulkit, going back to you, can you share the proprietary frameworks and research you use for actively rebalancing and evolving alternative portfolios?
Sure, happy to share some frameworks and research we utilize for this topic. So look, I think there are many themes and trends which keep repeating themselves throughout history, and what we use several lenses to look at how alternative asset classes would sort of are trending from an outlook perspective in the future, and a cross comparison is important here as well. So this page highlights 4 frameworks. The first one is a macroeconomic lens, which is how do different macroeconomic variables and their outlook impacts alternative asset classes. That's the top left. On the top right is, can you construct and break down the returns of alternatives into its various building blocks and see how those building blocks will perform in the medium term. The third on the bottom left is looking at a historical view, which is, is there cyclicality to these asset classes? And again, are those themes and trends? You can glean something from the historical data around them. And the bottom right is more fundamental, like what is the view from a fundamental sector outlook perspective. So what this page highlights is paints a picture of 2021, mid 2021. So this is a multi-alts portfolio which includes private real estate and infrastructure. And so the decision making here is you have marginal capital to deploy, and everything is sort of appropriately right sized in the portfolio. So where should that marginal capital go for rebalancing and portfolio evolution purposes? So now if you flash back to mid 2021, this was a period when the vaccine had been announced. This is a period of higher growth. Inflation was quite moderate and rates were quite low. So you run, and each of these frameworks were pointing higher conviction towards private real estate at that point in time. So that sort of informs a framework for deploying that marginal capital. And fast forward from mid 2021 to 12 months, private real estate actually outperformed infrastructure by 18%. These kinds of frameworks can inform how practically marginal capital could be deployed. But that sort of situation took a turn in mid 2022, 1 year later, which is again, flash back to that time period, the growth started moderating. Inflation started picking up at a very significant level. And at the same time, central banks started applying the brakes. So rates started rising at a very high level as well. So each of these frameworks then pointed towards a higher conviction towards infrastructure versus real estate, and that conviction sort of lasted a long time. And then if you look at the data, this is at the index level, infrastructure outperformed real estate by 18%, again, from a forward 12 months perspective, and actually did that over a more persistent pace. So these themes and trends do not change every month or every quarter. It takes a long time for these convictions to flip. So after having sized portfolios appropriately, this can inform stronger portfolio design, and active rebalancing could be utilized by using using the data which is now available, which was not available again 10 years ago. So the point here is there are many tools which investors can utilize.
Great. So before we get to the questions, Pulkit, let me ask you to, tie everything together, and maybe as a summary, why should public plans consider a diversified approach to alternative investing?
Yes. So we talked about the strategic asset allocation, building blocks of returns. And if I bring it all together here on this page, again, using some of the data and research, you can see here, this on the right-hand side, you can see a diversified portfolio, a balanced portfolio across alternatives, which includes return enhancers as well as cash flow producing categories. So there are three punchlines which emerge from like accessing a broader portfolio for alternatives, which the first one is we believe that again, more is better, but the more is better should acknowledge the constraints which investors have. And it's sort of, if you look at the way to look at that is if you look at this chart on the left, which is forward-looking return on the y-axis, forward-looking risk on the x-axis, you can see that orange dot, which represents that multi-alts portfolio. So anything above the blue line, which is stocks and bonds, adds to the efficiency of the portfolio. So this shows that, again, more is better from overall positioning of alternatives in stock bond portfolios. The second point is broader is better. And we talked about that there's a lot of non-correlations which exist between alternatives. What does that mean? It means that you can see the individual categories as those asset class dots on this page, but when you start combining them, you can move sort of the volatility to the left, which is a good place to be, which is lower volatility, tapping into the non-correlations or the zigzag nature of the underlying return streams. So there's more resiliency, broader is better. And then we hopefully talked about the fact that with more data and a broader menu, active is better as well, which is you can tap on the dispersion which exists at both the asset class and manager level and combine them to tap on their non-correlation. So you can see that orange area chart, which means you can either increase returns or reduce risk or do both through stronger portfolio design. So I would sort of summarize these three takeaways for portfolio construction in alternatives, which is more is better, acknowledging the constraints, and broader is better, and also actively designed programs are better as well.
Great. Well, thank you for that summary. All right, let's go to our questions. The first question we got is, how can we measure the illiquidity premium for closed-end funds or private funds? I'll open it up to either Susie or you, Pulkit.
I think we talked about that in this sort of the core versus non-core comparison, which is that the illiquidity premium is not a guaranteed illiquidity premium. There's a lot of steps which have to happen to harness that, which revolves around uh, manager selection, theme selection, strong execution. All those things have to align together to harness that premium beyond sort of the core construct. So, again, all these alternatives should be accessed in terms of what are you looking to solve for. You can also look at, if you're looking for return enhancement, you can lever up your core exposures or look at opportunistic, but the execution matters in each of these scenarios. And when we look at the premiums themselves, I have like in the sort of, when we look at the next for forward-looking lens, we believe you can see on the box on the right that highlights the typical premiums you can expect or at the median manager asset class level for each of these asset classes versus their public equivalents. And so that I would inform as the sort of the base case view. And again, the sources could be quite different. It could be operational improvement, it could be leverage, it could be sector selection, execution. All of those are combined sources for harnessing those premiums.
Susie, anything you want to add?
Pulkit highlighted in that alpha box, but I would also think one way to look at it from a simplified is the capital market assumptions. Implicitly or explicitly, if you compare the public equity versus the private equity assumption, you could kind of that difference or discrepancy attribute, again, simplified way of thinking about it, but attribute that to what the expected illiquidity premium would be. Now, to measure it in practicality, it really becomes a time horizon, whether you need to actually tap into that liquidity, because as long-term investors, we often don't even need that liquidity within the portfolio. So is there even a higher premium associated with that? But given the question did come up, I did want to piggyback off it to ask if we think or believe that the liquidity premium is shrinking as more investors or it becomes more widely available. Is the premia going to continue to compress? And will private investments actually be comparable to public equity and there's no longer a premium?
I would say that there is definitely more and more entrants coming in the alternative space today versus there were 10, 15 years ago. So that there is a capital flow effect, which sort of means that shrinking risk premiums more than anything else. But we don't see like big evidence today because it's the beginning of the new entrants coming into the institutional space. As of today, we don't see like massive shrinkage in alpha or these premiums we talk about. But as more and more entrants come, I would say that you can sort of then think of the alternative space as asset classes which are more scalable and less scalable or niche. And if the asset classes are scalable, so think of your real estate, infrastructure, private equity, which are multi-trillion dollar asset classes, the probability of lots of new capital coming in and shrinking that premium is lower there than it is going to be in some of the nichier segments of alternatives. If all the capital gets piled into those niche segments, and then we will see more sort of alpha dilution. And then I would also add that the sources of premiums are also shifting. So while in the era of zero interest rates, low interest rates, you can sort of have leverage on your riskier assets and add more incremental returns, which is going to be more challenging in a forward-looking regime. So again, operational improvements as well as proper use of better, stronger sector selection, asset allocation are going to be sources of alpha in the future.
Great. The second question we have is, are you seeing the increased use of secondaries for rebalancing?
Susie, why don't you take that?
I would say yes. There is an increased adoption of the use of secondaries. I think also with the proliferation of it becoming offered to the retail and kind of registered advisors, that's also how they're building out their portfolios to get exposure to offer to the generic public, I would say. Again, where I see it a lot is where either someone new comes in, there wants to be a large change in governance or policy, and you're going out to rebalance within the portfolio, as well as if you're trying to mitigate. But I do think there's increased use, and it will continue to get increased use. It's not going away. Similar to the compression. I mean, it's privates and alternatives are part of the global investable universe, and they're not shrinking, they're just growing. And how big that growth is, as well as what the different types of vehicles, investment offerings, structures, types of assets that we may not even know about, that we may be investing 20 years down the road, is also very much on the horizon in this new world. So yes.
Great. Pulkit, anything you want to add to that?
I think, yeah, I mean, secondaries, of course, they existed for a long time, but now we see, because of the 2022 denominator effect and also lack of distribution, especially the sort of larger end of, let's say, private equity, there's a bigger sort of role they are playing now, both from an LP and GP perspective. But we also see that the secondary market is expanding to multiple asset classes, which used to be mostly private equity, now to credit and other sort of even hard assets. So I think, as I agree with Susie, it's here to stay, and it's a tool which investors and both LPs and GPs can use. Although at the same time, again, with more capital coming into that space, there's going to be also shrinkage of some of those discounts, which used to be more steep again. But the opportunity set still remains robust. So proper evaluation of secondaries across the food chain is very important.
So we have a third, I think it's more of a statement. So let me read it to you, and I'd love to get both of your reactions. So regarding liquidity, the open-end core real estate strategies aren't exactly liquid, as the redemption queues are fairly long. Susie, reaction.
Yeah, well, liquidity is a function of sellers and buyers in the market, and the willingness for somebody to exchange and transact. So you could think about even fixed income. It may be daily traded, but it can actually be, depending, floating rate, some of your credit type instruments. You can't trade on day one, day two, day three. Some could take up to 30 days, but they're just within vehicle constructs that allow one to transact. So I think that goes back to defining what liquidity means and the use of liquidity, and then managing that liquidity. But yeah, I think somewhat it's a misnomer of liquidity or daily traded is equivalent to liquidity versus, lockup or kind of an open end with a queue or a closed end type vehicle that doesn't have day-to-day liquidity. So I guess everything could be, again, it depends on circumstances.
Yeah, I think that's why I totally agree. And then I think from a portfolio design perspective, again, these alternatives in general are underlying asset classes are illiquid. So they should be thought of as, to harness these benefits, the trade-off is illiquidity. But again, today investors could use diversification in their favor by diversifying that semi-liquid exposure they have, because they tend to be highly non-correlated to each other. So liquidity can be tapped from multiple uncorrelated segments of alternatives. That's, I would say, which is possible today and was not possible 10 years ago, because of the widening of that open-end or evergreen menu across multiple alternative asset classes. And secondly, I think we talked about public and private. So thoughtful blending of the two is another tool. But I think going back to Susie's earlier point is, how much liquidity do you need? Do you have enough liquidity in other parts of the portfolio? What's not a good thing to do is to be a forced seller when there are drawdowns and then sourcing liquidity from these asset classes. So again, asset allocation, diversification, and right sizing a public and private blend are tools to mitigate against sort of that concentration.
Well, great. Pulkit, Susie, thank you for this wonderful and insightful discussion. And thank you for everyone who joined us today. At NCPERS, we're committed to helping our members tackle complex challenges like with this practical high impact education. We appreciate our speakers for contributing to that mission. Our next webinar will be held on July 15th on our latest research, Unintended Consequences, a 2025 update on the 2020 report. Thank you, everyone, and have a great balance of your day.